Unveiling chart patterns, a roadmap to market trends. Chart patterns reflect the collective behavior of buyers and sellers, offering insights into supply and demand. Imagine them as footprints on a sandy beach, revealing the direction of the tide. These patterns are recurring formations studied by traders for decades. Traders look to chart patterns to navigate the complexities of the financial markets. Recognizing these patterns helps traders anticipate price breakouts and reversals. Bullish patterns, riding the wave of upward momentum. Bullish chart patterns signal the potential for an upward price trend, indicating that buyers are gaining strength in the market. These patterns are like beacons of hope for traders seeking to capitalize on rising prices, offering opportunities to ride the wave of upward momentum. One such pattern is the inverse head and shoulders, a powerful formation that often marks a reversal of a downtrend. This pattern resembles its namesake, with two shoulders flanking a head but inverted, suggesting a shift in market sentiment from bearish to bullish. As the price breaks above the neckline, a resistance level connecting the two shoulders, it signals a potential surge in buying pressure. Imagine a compressed spring, full of potential energy waiting to be released. That's what a bullish chart pattern represents, a buildup of buying pressure ready to propel the price upwards. By identifying these patterns early on, traders can position themselves strategically, entering trades with the potential for significant gains as the market rallies. Bearish patterns, navigating market downturns. Bearish chart patterns, on the other hand, signal the potential for a downward price trend, indicating that sellers are gaining the upper hand in the market. While these patterns might seem daunting, they offer valuable insights for traders seeking to protect their capital and even profit from falling prices. One such pattern is the double top, a bearish formation that often marks a reversal of an uptrend. This pattern resembles two consecutive peaks at roughly the same price level, forming a resistance zone that the price struggles to break through. The failure to surpass this resistance signals a potential shift in market sentiment, with sellers taking control and driving the price downwards. Think of a ball thrown into the air. It reaches a certain height before succumbing to gravity. Similarly, a bearish chart pattern suggests that the upward momentum is waning, and the price is likely to descend under the weight of selling pressure. By recognizing these patterns, traders can adjust their strategies, exiting long positions, or even entering short positions to capitalize on the anticipated downward move. Section 4. Chart patterns in action, from identification to execution. Trading with chart patterns is not about blindly following signals but rather about incorporating them into a well-defined trading plan. The first step is identification, recognizing the pattern as it forms on the chart. This requires a keen eye for detail and a solid understanding of different chart patterns and their characteristics. Once a pattern is identified, the next step is to wait for confirmation, typically in the form of a breakout. A breakout occurs when the price decisively moves above a resistance level, for bullish patterns, or below a support level, for bearish patterns, signaling a potential continuation of the trend indicated by the pattern. After confirmation, traders can enter a trade in the direction of the breakout, setting appropriate stop-loss and take-profit orders to manage their risk and potential rewards. The stop-loss order acts as a safety net, automatically closing the trade if the price moves against the anticipated direction, limiting potential losses. The take-profit order, on the other hand, secures profits by automatically closing the trade when the price reaches a predetermined target level. Section 5. Mastering risk, safeguarding your trading journey. Risk management is paramount in trading, and trading with chart patterns is no exception. It's essential to approach trading with a disciplined and calculated approach, never risking more than you can afford to lose. One crucial aspect of risk management is position sizing, determining the appropriate amount of capital to allocate to each trade based on your risk tolerance and the potential reward relative to the risk. A common rule of thumb is to risk only a small percentage of your trading capital on any single trade, typically 1 to 2%. Another vital aspect is setting realistic profit targets and stop-loss levels. Avoid the temptation to be greedy or let emotions dictate your decisions. Instead, determine your profit targets and stop-loss levels based on your analysis of the chart pattern, the overall market conditions, and your risk tolerance. Remember, trading is a marathon, not a sprint. By mastering risk management and approaching trading with a disciplined and patient approach, you can increase your chances of long-term success in the exciting world of financial markets.